Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. Today is the 28th of October, 2024. My name is Rocky Johnston. He's been on the podcast before, so great to have you back, Rocky.
Thanks, Brendan. Good to be
Rocky
back.
is a financial advisor here at Prosperity, and we get a lot of mutual clients. Always good to chat to Rocky about a few things, and we were sort of spitballing and talking about something for this podcast that we had coming up. And we started talking about the one percenters. So the little things that make a difference and, save you thousands of dollars. That's sort of what we're talking about.
Yep, that's it.
Rocky, well, what are some of the things I think we talked about? Super contributions. What else are we going to, and obviously if you make super contributions, that's good. Don't just tune out because you make super contributions and think that's all. Was the super contributions, interest rates, and offset accounts.
Yeah.
I'm going to run through a couple of examples of those, some slight tweaks, slight differences.
Yeah.
A lot of people might do these, but it's like, how much does it mean? Is it really worth it? A little bit of stuffing around here and there. How much does it save me? Is it thousands? Is it tens of thousands? Or is it hundreds of thousands? We will find out, and we'll run through some examples. But with all of these things, just because you're doing it, make sure you're getting the right advice to do it the exact right way. As with all of these things, if you just have a crack at it yourself, sometimes it doesn't quite work the same. So always good to get the right advice. So chat to Rocky if you haven't already, or one of the financial advisors at Prosperity.
Yeah.
Rocky, kick us off. Super contributions. What's the one percenters there we're talking about?
Yeah, so I guess with super, there's so many different variables involved. It's like you can always hear about people talking about the fees and the investments and all that kind of stuff. But sort of break it down to just making sure you're maximizing your contributions, or just putting that a little bit extra in. Like we often see people, just letting their employers put the contributions in and that's it, and maybe doing a top up here and there. But I just wanted to quantify what that actually looks like. And especially when you're looking at sort of over the long time, like we're catching up with a lot of clients, in their 30s and 40s, and it's hard to get excited about super when you're sort of 30 years away from access. But just wanted to encourage you, even doing, say for instance, $100 a week, five grand a year, say for instance, if you would just put in $100 a week into your super, and you compare it to just, either put it in your savings account or your offset account or an investment account, say for instance, it's a huge difference long term. So super's an amazing beast. You get to get a tax deduction for investing, which you can't get anywhere else. So the government set it up so it is favorable to use. So just some high level numbers. Let's talk $100 a week. Put it into your super fund, or say for instance, investing in a portfolio of shares, say for instance. So same sort of returns inside super and outside of super, except there is a tax difference there to consider.
Apples for apples, we're talking the same percentage rough return you're talking
about. That's right, yeah. So putting money into super, looking at that, your $100 a week over the long term versus, in your personal name. We're calculating.
I assume this is a personal name if you're on the higher or close to high tax bracket.
Yeah, that's right.
Obviously, if you're making 30 grand a year, this wouldn't be necessarily the same difference.
Exactly right. And that's another reason, just echoing Brendan's comment from earlier, always worth having a chat with your accountant and financial advisor just to make sure that the strategy works for you. But yeah, say you're on a decent income, you're in, say the highest marginal tax bracket, putting money into super, say the $100 that we talked about earlier, versus investing, it's about $60,000 as a net benefit. So
over how long? How many years?
20-year period.
So 20 years, just by putting it in super versus putting it in your own name?
Yep. So we're looking at that $100 a week. It's about
that's only $5 grand a year we're talking. That's $5,200 a year.
Yeah.
And it's going to save 60 grand over 20 years.
That's it. So 60 grand might not sound like a lot, but we're talking about $250,000 versus $190,000. That's the difference in sort of higher level figures, just with, various different figures assumed, but at a high level.
that much. Like it's
Yeah,
a doable number.
yeah,
And that's 60,000, as you say, that's not how much you make. That's the
yeah.
tax saving. You make more,
That's
you
right.
make more, but the tax saving is 60 grand between
That's
doing it in
right.
your own name versus doing it in super.
Yeah,
Obviously, there's drawbacks, can't get it out, blah, blah, blah. But if
yeah.
sorry, you can get it out down the track, but can't get it out immediately.
That's
You
right.
need for a home loan or whatever, it's different. Understand all of those things, but just
True.
pure numbers,
Yeah,
60 grand.
yeah.
Yes,
And
please.
I feel like $100 a week, like a lot of people can sort of find that. And if you're setting up, so it's going through, your payroll or automatically just happening, we're really big proponents of automating things. Like if
Yeah,
you,
exactly. If it comes out your pay before you even know it,
yeah,
you can't spend it.
that's right. That's right. So if we're talking about the $5 grand a year, that's going to be, a $250,000 difference over 20 years. It's absolutely not worth sneezing at. You should be considered. So it's just a little 1%er. It's little things that
And
add up.
I know that you've already done the numbers, so I can ask you this question versus savings account, which you prefaced earlier. If I drop it into a bank account,
Yeah,
savings account, that gets me, I don't know, what do you get in a
yeah,
term deposit
4%
savings or
savings.
something?
So you get 4% on your saving. If you are in that sort of highest marginal tax bracket, 4% is really 2% because you pretty much lose half. It's pure interest, so it's pure taxable income. You're not getting franking credits or anything like that. So if you get 4%, it's really 2%, and then the difference gets pretty huge. So before I talked about $250,000 versus 190. In this case, if you're looking at just a savings account, at the end of that period, you're essentially $135,000 better off.
Which is, do the maths for me,
125,000 versus
125 less
250.
than the super.
That's right. So it's a pretty big difference. Like these are some
And that
pretty big figures.
and that only gets bigger over time because if the
It
money's
does.
in super, it's growing within super
Yeah,
and a better tax rate. So over 40 years, it's just bigger and bigger. It's compounding,
that's right.
compounding. It's just getting bigger and bigger.
Yeah. And then you get to retirement, potentially put it in pension phase and 0%. It just gets better. So super, don't discount it. Put your deductible contributions in, but speak to your accountant and financial advisor first.
Easy no-brainer, 100% agree. Obviously,
Yeah,
there's concessions, there's contribution limits and things like that as well. So
that's
get the
right.
advice on it. But $100 a week, very doable, saves it. 1% is 60 grand or 120 grand, depending on which way you would have done it previously.
Yeah.
Interest rates. So
Yep.
interest rates are going up a bit at the moment. There's talk of them coming down later. Who would know? See what happens. If I'm on a 7%, 6.5%, 6%, whatever the rates are roughly at the moment,
Yep.
but how big a change is it? It's sometimes it's like 0.5%. Do I change?
Yeah.
It's a bit of a, is it worth it? And
Mm.
I know you've got the answer, so talk
It
me
is
through
worth it. Spoiler.
it.
um, I it's always one of those things. It's difficult to do a refinance or speak to the bank or reach out to someone. But I feel like when you're getting hit with the numbers, it's worthwhile. Like your time is worth a lot in this case. So you're looking at, say, for instance, a $1.5 million loan, which is fairly standard nowadays, especially for our clients. If you're looking at a sort of 30-year time frame, you pay minimum repayments, which I know is not always the case, but say, for instance, you're paying your sort of standard repayments like 7% interest rate. If you look at that versus, say, 6.5% interest rate, so
0.5% saving, a bit of
0.5%.
negotiating, speaking to the prosperity brokers, getting a bit of a
Yep.
better rate. Hey, we can save you 0.5%. Do you want to do it?
What does that actually look like? It's $175,000 in interest difference.
Over the life of the loan,
Difference over the life of the loan.
170 grand
170 grand.
interest.
It's huge.
That's a good one. That should be called a 2%er. That's a bit more.
Yeah, that's right. Well, speaking of 1%, let's talk 1%. So what's the difference between a 7% and a 6% interest rate, which again, we see every single day with our clients. We're speaking to some of the brightest minds, the most fantastic clients, but a lot of the time you just kick the can down the road,
It's a set and forget sometimes, and you don't look at it. If you don't look at it, it's going to get up. It's going to creep.
The banks make it really hard to find your interest rate as well, I find. You've got to click so many different buttons to see what it is. But let's talk 1% difference. Same variables in every case, your 30-year time frame, everything like that. Same.
1.5 mil loan, 30 years, yep.
$355,000, Brendan.
It's a lot, isn't it?
$355,000. It's massive.
And that's not tax benefit, none of that.
That's just
home
pure
loan sort of
cost.
whatever we're talking, yeah.
That's exactly right. So even
So
if
0.5% is more realistic. You'd hope no one's out there being a percentage over the current rates, but a lot of people I think would be, 0.5% above and haven't pushed it enough, and it's close enough, I'll let it go. Is it worth it for 0.5?
Yeah.
$185,000. I know it's over 30 years, and you're probably going to look at this every 2 or 3 years and refresh it, and use a broker where they do the legwork for you, but set up a reminder and look at it every couple of years and ring us and find out. And
there's a thing called the loyalty tax, which I'm sure everyone's very aware of, but you do get the best rates if you're a new customer. So it's just worth, asking the question, putting a bit of pressure on, even if it's 0.1%, there's still savings to be made there.
0.1% is now. We're getting to the nitty-gritty.
That's it. That's right.
Yeah, but I agree. But I mean, 0.5% is there'd be a lot of people out there, I think, who could save 0.5% on their home loan, and 185 grand over 30 years. I hear you, that's a lot, but I mean, that's a long period of time. It's 185 grand. That's still a lot of money.
That's right.
We're big on big advice, and we do a lot of structuring, and we do a lot of great tax advice here. And you guys do it. Rocky does a lot of investing with clients and those sort of things, and that makes money. But why not just get the 1%ers right and just save more and more and more? It's just a simple thing. And the other thing we want to talk about, Rocky, you got that. All right, so we're saving that extra 0.5% or 1%. Hopefully not 1. Hopefully it's only a half. Hopefully it's not too far out of kilter your loans.
Yeah.
Paying down. I want to pay down my mortgage. Mum and dad, bricks and mortar. You got to pay down the mortgage. That's what you got to do. That's what they tell you. We don't say that. We're a bit more of an offset family over here. Offset versus paying down the mortgage. What's the 1%er there we're going to look at, Rocky?
Yeah, so this one's a little bit more complicated, so bear with me. But Brendan and I are both quite passionate about this strategy, and for good reason. So I'll explain it. Another big 1%er. So let's go through a quick hypothetical scenario here. So I've got 2 clients. One client we'll call Dr. Savvy, and the other client we'll call Dr. Procrastinator.
Okay? The Savvies out there.
Yeah. So Dr. Savvy essentially sets up an offset account from day one, makes his minimum repayments, and then puts everything else sort of in the offset account, which, look, a lot of people do that already just naturally, but a lot of other people, like Brendan was just saying, let's just pay it off. We hate debt. We don't want this loan. So you've got 2 people, one person, Dr. Savvy, prioritizes their savings in their offset account. And there's benefits from that from a, liquidity perspective and everything like that. But let's just talk high level numbers. Dr. Procrastinator, they just pay down their loan.
They'll do it tomorrow.
Yeah, that's right. That's right. Yeah. So you get to say, for instance, we've done some calculations. So say both of these clients get to that stage where they've essentially paid out their mortgage. So Dr. Procrastinator, he's paid it down to 0, no mortgage. They've just got a house, and they're at that stage now where they probably need an upgrade. They've got a couple of kids. They're probably outgrowing their space. So they go and purchase another property, and then what most people do is they rent out the old place. They just rent it out. And so what happens in that scenario, so Dr. Procrastinator, no loan, did the right thing, so they thought. But what happens in that case is now they have to get a great big whopping non-deductible loan against this new property. They've got an old property that's being rented out with no loan against it. And you can probably see where I'm going with this, but the old property not having a loan is actually not working in their favor because they don't have any non-deductible debt.
And just a little trap there. A few people ask me this occasionally. It comes up that they say, well, but I'm using that other house as the equity. Can I just borrow against that first house and I'll put $500,000 of the debt against the first house and the rest of it against the new house? Well, no, you can do that. You can call it whatever you want in the loans. But at the end of the day, the deductibility of interest depends on the purpose of the borrowing. And if you fully paid down a loan against the first property, the house you were living in, that's now going to be the rental, and then you're buying a new property, If you're borrowing to buy the new property, doesn't matter what collateral, where you call it, what you name it, the purpose of the borrowing is to purchase the new property, which is your principal place of residence, which is non-deductible. You can't just create a loan and put it against an existing asset and claim it's for that property, when in reality, it's just using the equity of that property to create a new loan. Whereas the Dr. Savvy that Rocky and I have been advising for many years has the offset facility. I think in your example, we're saying $500,000. Is that right, Rocky? Say $500,000 in the offset. And same as Dr. Procrastinator, instead of paying it down to zero, they've still got a $500,000 loan and $500,000 in the offset. They still pay zero interest. It works exactly the same as paying it down. But the benefit is that loan has been borrowed for the purpose of buying that existing property, which is now an income producing property, and that interest on that loan is now deductible. They can remove the offset and the $500,000 loan still, and I'm stealing your thunder here, Rocky, still stays there. And that is now, the interest on that is now tax deductible. The $500,000 offset plonks over onto the new loan, and it offsets the new loan. And I realize I'm using my hands on a podcast here, but maybe if someone watching on YouTube will see me actually doing this with my hands.
Yeah, that's right. So yeah, you're essentially in a position now, like assuming, say you've got a $500,000 mortgage, got it fully offset, and then the other client's fully paid up their house. So yeah, there's no interest paid. However, when you do move house and new principal place of residence, rent the old one out, if you pull the offset money out, put it towards the new loan, you've got $500,000 off this next loan. So the total debt's the same in both scenarios. However, that $500,000 of debt on the old property that is now being rented out, importantly, it does need to be rented. It does need to be producing income. Once it is rented out, you can now claim that as a tax deduction. So even though both scenarios, you've got the exact same debt levels. So say you've purchased a place for $2 million. The first client has borrowed that entire amount, say it's a $2 million loan. And then the second one has taken their $500,000, and now they've got a $1.5 million house, and then $500,000 on the investment property, their old house. They've got $500,000 that is tax deductible. That's the difference. Same debt position. One person has $500,000 in debt that's deductible. The other person doesn't. That's essentially the outcome here. So what is that? $500,000 at say 6.5% interest. It's $32,500 a year. That will save $15,000 in tax for someone on the highest marginal tax.
And that's every year.
Every year. So say 10 years. So say you bought the first place in your 30s and now you're in your 40s, you've outgrown the current house and you're moving on. After 10 years, $15,000 per year of deductions is $150,000 in 10 years.
So that $15,000 a year, if we combine these, and I bet you haven't done these numbers, but if we combine that and get it 0.5% cheaper, and then we invest that in super, not that we'd have to watch the contributions caps. What are we up? $500,000 after 20 years? There'd be thousands upon thousands in there. But you're at $15,000 a year just by using an offset account. And that's in a specific scenario we've given where you're upgrading to a new home after 5 or 6 years and you've managed to pay off your old one or pay it off effectively by using an offset. That is not it's a made up scenario, but it's not uncommon. That absolutely happens. You see it all the time. A couple of kids, 2 or 3 kids, all of a sudden you need the bigger car, you want the slightly bigger house, you're doing well. You invest in a bigger house, and we have a lot of conversations where people want to rent out the existing. I had 2 clients last month talking to them about that exact situation where they're getting a bigger house. What do we do with the old one? Is there an offset? Great, we've got some options.
That's exactly right. So this is very common, and
we're not talking. That's not debt recycling strategies.
No, we haven't got complicated.
This is just simple stuff. We can get into the complicated stuff, but this is just the simple stuff.
That's exactly right. So it's just about which most people have. Most people take on debt. Most people can review their interest rates. Most people can put a little bit more into super. And it's just about using them in conjunction, Brendan. Just be using an offset, review your interest so you're paying less, and then put the difference into super. You can do all 3 at the same time. I've added them all up, like everything that we've spoken about today. And we're talking about $400,000 to $500,000 in total.
You did actually put them up, did you? I was joking, but you did. Okay, good.
Of course I did. And that's just, that's pretty common. So for people to be in a, similar sort of spot, similar buying the similar house, having a similar super fund, similar sort of loan value, but someone to be $400,000 better off by making a few tweaks, earlier in their career, or even, even later on as well.
And if
We're
that's
talking to
20 or
people.
30 years down the track, it's even more and more and more. Like,
That's
it's
right.
just
Yeah,
get the simple things right,
that's it.
pay for a little bit of advice and speak to the right people and get it right and do
That's
it
right.
early.
Yeah.
Make a huge difference.
Yeah. Exactly
Rocky,
right. So,
I think that's 3 good topics, 3 simple things. How do people talk to you? I guess rjohnston@prosperity.com.au, or
that's right.
contact
Yeah.
your advisor or Prosperity, talk to one of the financial advisors, come and have a chat to us. Got to get that sorted, get the simple things done right.
Yep.
And we're good to go. Rocky, appreciate it. Thank you very much for coming on the podcast as always.
No, thank you.
Anyone else who wants to go back and listen to some of the other podcasts, find one that Rocky and I did probably a year ago now. That'll be up there as well. Go to prosperity.com.au, go to the website, find the podcasts, tell your friends, like and share, give us some stars on this one, follow the series. We'll talk to you soon. Thanks, everyone.
Thanks.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.